Thank you so much for joining us. Tell us what you're seeing now that the everything rally is over. What's the divergence you're seeing within the tech space?
That's right. I really think the everything rally, as you just said, is over. People have dumped some of the more speculative growth-focused names, whether that's the ARK Innovation Fund, Plug Power. They have fled those names, and at the same time, we've obviously seen stocks like Apple outperform. And I think it goes back to some of those growth-focused, unprofitable names have taken a beating lately. As the Journal reported today, more than 300 unprofitable growth names are down more than 50% from their highs. That's compared to the NASDAQ, the broader NASDAQ being down around 7 or 8% from its highs. So there's really a big divergence between the more speculative corners of the growth space and some of the other winners.
And what about this coming Fed rate hike cycle? What can we see or take from history to help us understand what's going to happen next year?
So one of the themes that keeps coming up in my conversations with investors is, are we going to go back to or stay in this low yield environment, go back to more sluggish growth? And that was, the perfect storm for tech to flourish. Tech did really well over the past decade. And now I'm hearing investors ask, is that environment going to come to an end? Obviously, inflation is one of the biggest wild cards there. They're asking, how much are yields going to rise? And one thing I was thinking about is going back to 2015, when the Fed was first lifting off for the first time since the financial crisis. I was surprised to see that Amazon and Netflix were two of the best performers in the S&P 500 this year. So I think it goes to show you that the sector is pretty tough to bet against, even though a lot of people are calling for kind of this rotation into more cyclical corners of the market right now.
Gunjan, I wonder how you're thinking about the remarkably wide dispersion in 22 year-end S&P targets right now. The strategists are all over the map. But even those who think we're going to get some kind of multiple compression next year, they do admit that at least S&P earnings are looking to be pretty good at this point, whether that's a result of growth or buybacks or what have you.
So one thing I keep hearing is that it seems like earnings will grow more and more important. And we're seeing that with the Micron move today, these huge moves we're seeing in tech and software companies after their earnings, some of the biggest moves after earnings of the past decade. But I think in terms of the dispersion, that speaks to just the number of challenges we have ahead of us. Right now, it's the variant. Obviously, inflation has been at the forefront, supply chain issues around the globe. It just seems like wild card after wild card keeps coming our way, and that's reflected in that dispersion that you're talking about.
Gunjan, a piece I enjoyed in the Journal this morning was about 5 big stocks that have been holding up the S&P, right. Microsoft, NVIDIA, Apple, Alphabet, and Tesla. Now, there tends to be this thought, well, out of this and into that. But, I mean, what if none of these things is really safe? How much risk do you see in those 5 stocks if they get re-rated?
That's a good question. I think it goes back to, kind of what we were talking about earlier, where I feel like for so long, people have been calling for this rotation away from those stocks, and it just hasn't happened yet. It's almost like the boy who cried wolf at this point. And I've been speaking to a lot of retail investors this year. Many of them have piled into the market over the past year, and they kind of consider those stocks the safety plays. They're piling into the Teslas, the Apples, the Amazons of the world, and they really view them as pretty bulletproof. So, if that changes, that's definitely a big risk to the market. And of course, some of those stocks have seen some weakness lately, and that's weighed on the broader market in recent weeks.